as we understand them, we can probably start making better decisions, avoid some of the traps that a lot of investors or traders fall into. Mike, any words of wisdom as we get started here?
I think you said that very well. It's probably exactly what I would infer from the topic. I know that we've done this, quite a few times, but just how you make decisions is has a greater impact on the decision that actually is made than most of us will care to admit. So I think a lot of this stuff is good not only to visit once, but to keep on revisiting as your life kind of changes, different life events, things of that nature. So for those that maybe have listened to this once or twice before, or feel like maybe they have a good beat on this, it's always good to revisit.
Absolutely. So wait a second. You're saying all the decisions I've made that worked out really well are not from my skill, and all the bad ones are because of somebody else?
Something like that. There's a
Oh,
healthy dose.
yes.
There's a healthy dose of randomness brought into almost every decision we make. But we'll get into a lot of that stuff here in a bit.
Absolutely. I love that. I love that. All right. So obviously today, any questions you have, please type them in below. We're always looking for questions. We want to be able to address around this topic the items that are most important to you. Secondly, let's do a quick disclaimer here. We don't plan on talking about any stocks, but any stocks or securities we talk about, we're just going to use them purely for educational and informational purposes only. Second big one, remember, past performance does not always guarantee that future result. Everything needs to be looked at, analyzed, understand the risks of what you are about to take on, and please weigh those versus the benefits. Understand what outcomes could possibly occur. And I'll leave you with this last one because it's a big passion of all of us here at Charles Schwab. Please start working on a plan of what you're trying to do. I think if there's one correlation between success in investing, success in trading, it is those that have started to develop a plan have better results than those that do not. So that's our disclaimer for today. Let us get started. All right. The three main areas that we are going to talk about today. The first part, we call it behavioral finance insights. We're going to look a little bit at why do we make some of the decisions that we do? Okay, what is going on? Okay, then we are going to look at three common investor biases. I think I'm going to change that slightly today, and I'm going to scratch out that word three. I think I'm going to add two more to us. I think let's touch on five different ones today. I know there's a couple extra that we would like to bring in as they are very relevant to what is going on in today's market. And then finally, the third big area here is, okay, once we understand what is going on, why we might make some of the decisions the way we do, some of the traps that we see for ourselves, how do we actually overcome it? What are some of the very basic things you can do as an investor or a trader to help start making better decisions? So that's what we have planned for today. Let us get started with our behavioral finance insights. All right, we're going to start by asking this question. And think about this. Think about this. And if you'd like, please type in a response there. How many of you out there watching today consider yourself an above average investor? If you think you are an above average investor, why don't you just send us the letter Y? Type in the letter Y and send it to us. If you think you are not above average, send in the letter N, no. So Mike, I'll ask you real quick. Would you give yourself a Y or an N?
I'd probably give myself a Y, just considering the background and the years that I've been doing this professionally.
Yes. Okay. So we got a yes for you. All right. So please send those in. If you think you're a above average investor, send in a Y. Type it in, send it to us. If you feel you are not an above average investor, please send in the letter N. And we'll take a quick tally here. I'll tell you right now, I think the N's, believe it or not, seem to be outweighing the Y's.
Hmm.
All right, all right. Let's take this another step. Let's take this to something maybe we do every day. Okay, we're going to come back to the investing, but let's look at it this way. How many of us out there that are listening consider yourself an above average driver? Okay, so we're going to do a quick poll again. If you feel you are an above average driver, please type in the number 1 and send it off to us. If you feel you are a below average driver, please send in the number 2. Type in the number 2 to the question area and send that to us. And we're going to do a quick poll here also. Okay,
I got
so
to ask.
above average driver, send a 1. Below average driver, send the number 2.
I got to ask,
All right,
Rob,
Mike,
what's your answer to this one?
uh, well, your friendship, my friendship with you goes back a long time. I think you know the answer to that one. I am definitely in the number 2 camp, the below average driver camp. All
Just
right,
want to
so
make
I know
just want to make sure certain life experiences haven't changed your opinion, buddy.
yes, you're exactly it. You're exactly it. All right. All right, we're getting a lot of above average drivers. I like that. We got a lot of below average investors. We got a lot of above average drivers. All right, now why are we asking this? Why are we asking this? AAA, the Automobile Association of America, asked that driving question to people, and they found that 73% of people considered themselves above average in their driving skills. Now, that might make you take a pause and scratch your head a little bit and go, wait a second here. How can 73% of us be above average? Doesn't average sort of mean right at that 50% level? So 50% of us are better, 50% of us are worse. Makes you think a little bit there. Now, think about how that applies to your investing. Think about how that applies to your investing. Okay. So the reason we ask this is we have to understand then sort of why we make some of the statements we do. Why do we have some of the perceptions that we do? Okay. Mike, any additional comment on that whole concept of thinking about average investors or average drivers or really average anything for that matter?
Yeah, I'm going to key off that word that you just used, that perception word. Oftentimes when I go through this and answering those questions with you, I often think about whether or not as a driver, what is meant by average or above average for that matter, right? Is it safety? Is it speed? Is it a number of different things? And, as an investor, right, is it above average in stocks or equities? Is it above average in fixed income, risk, growth, right? There's a number of different ways to think about that. So I would just say that in order to kind of, understand yourself, you probably want to understand your perceptions. And I think that this presentation does a really good job of making us think about that.
Now you bring up such an important point. I think especially when it comes to investing, I see too many investors get focused on return, and they fail to even examine the risks they're taking to get that return. Yet alone, I think even the more important question to ask up front is, what return do you need? Have you done any analysis around what return you need to reach the outcome or the goal that you're setting for yourself? Maybe you don't need, equity-based returns to get your money to do things for you. So maybe you're even focusing on the wrong goal at the outset.
Yeah, I think that's a great observation. And one that I think in the last portion of the presentation we addressed a little bit. So that's a really good segue into something that we're going to do later.
Excellent, excellent. So let's dig a little bit deeper then. Why do we make some of these decisions? Mike, can you walk us through what this slide is trying to get us to think about? No pun intended, showing a brain there, but what is this slide trying to get us to think about?
Yeah, I think the heading kind of speaks a little bit to it, Rob. I mean, our decision making and the parts of the brain that we access in terms of making decisions, our brains are certainly very, very efficient. And if you think about it, that oftentimes means that in making decisions either quickly or with minimal effort, oftentimes we might make some shortcuts. We might rely on some experiences. And you can see some words here associated with the different sides of the brains that we're calling out here. Inner and outer is one way of thinking about it. Fast and slow is another way of thinking about it. But you see that a lot of the words that are sort of connotated from an emotional reaction are really on that inner brain side. And then some of the rational thinking, some of that slower thinking is really done on the right side. And I think you can sort of ascertain that when we make decisions, some of them have to be done very quickly. Some of them done without thinking at all, right? We just got off that driver slide. I would argue that a lot of decisions you make on the highway, you do sort of without even thinking about it, quote unquote. But as we think about the decisions we make as an investors, I think it's very, very important to think about the ones that we do on autopilot versus the things that we actually rationally consider. Rob, I know you have lots of thoughts on here too, so I want to save some time for you. What do you think?
Yeah, I like that. Thinking about the driving. Yeah, you see the brake lights in front of you. It's all, you don't even think about it. Your foot's already going to hit the brakes on your car, absolutely, or truck. So, all right. So I think about this because I think about that emotion, and I think about our lives. Whether it be inside of investing and trading or even outside. When you think about emotional decisions, or those quick decisions that you make without thinking about it, would you classify those as some of your better decisions that you've made? I look at myself and I would go, self-reflect and say, those are probably not some of them. Those are probably ones I'd rather do over, have another shot at. And when I think about that concept as it applies to investing, is the big first step is, how do you even know that you're thinking emotionally about an investment or a trade? Okay, I think there's some warning signs, and I call them the bad four-letter words of investing and trading. Just like we have bad four-letter words that you're not supposed to say on Schwab Live Daily or TV or radio, okay, we have these ones that when you start to hear them and say them and think them, it's a sign that you're going down an emotional path. Okay, here's one of them. How about hope? When you're using this around an investment, boy, I bought this stock. I hope it comes back. That truly means to me you probably didn't have a process up front, or at least even thought about what risks you're willing to tolerate in order to get the return you thought you could have from that investment. Okay, hope is very much an emotional reaction around an investment. Okay, I'll give you another one. How about need? You need something to have happen. Okay, love. Okay, be careful loving 3 and 4 letter symbols. Okay, I do have a rule of thumb. Please only love things you can physically hug. Relatives, spouse, kids, parents, friends, dogs, cats, birds. If you've attended this before, snakes, right? You can hug a snake. Cars,
Never gonna live that
boats.
down.
Right. Please don't love 3 and 4 letter symbols. They're just vehicles to make money. And then finally, I think the granddaddy of them all is pray. If you're invoking prayer around your investment process or your trade process, that's very, very emotional. So Those are some of my big thoughts around that. If you hear those, you go out, I know we're social distancing now, but if you start hearing friends talk about that they start using those types of words around an investment or a trade, that should be a warning sign to you. You're maybe going down an emotional path. Maybe you got to do something more on the outer brain side to think about what's going on here. What's your plan around it? Anything to add on top of that, Mike?
No, I think that those observations are spot on. That last one is kind of a pet peeve of mine. Just because it's so far removed from kind of that process portion of the brain. I would add probably belief and faith into those things, but they don't fit into that 4-letter word characteristic, but certainly along the lines of pray. But again, anytime you're using those emotional triggers, just sort of assume that the wrong side of the brain is probably driving the bus. It's some part in that decision.
Yes. So as we wrap up this first little section here, we touched on that whole concept of the behaviors of investing. What other things do you look at or read, Mike, that we can maybe guide our audience members toward to get more information around some of those behaviors?
Yeah, at first, I do a lot of reading, both online and then also obviously physical reading, but a couple of books. I am sort of infatuated with this topic, and especially all the different places that it shows up, because to be fair, it shows up in a lot of places that aren't investing-oriented books, but there certainly are a number of investment-oriented books that cover this. I think, first of all, the one that everybody kind of points to or knows is Thinking Fast and Slow by Daniel Kahneman. That's it's a difficult read, but it's certainly a beneficial one if you're interested in some of this stuff. An easier one would be, Blink by Malcolm Gladwell. I think that's actually a fun read, but speaks to the processes of making a decision. But there's just a number of them. One of my favorites that maybe we'll talk about a little bit later is Thinking in Bets by Annie Duke, a professional poker player. Kind of talks about decision making in terms of odds, but there's just a number of different ones out there. But those are three that sort of stick out in my mind. I know, Rob, you talk about a couple internal resources that are good ones. What do you got for us there?
Absolutely. Here at Schwab, we have a great podcast under the name Choiceology, put on by Katie Milkman. I really like that podcast because I think that one really gets into a lot of these types of behaviors as to why we do the things that we do. And it's not necessarily always in the financial world. I know her most recent one is really around the subjective ratings of wines. So if you like wine and you like to read the ratings on them, please listen to her most recent podcast. Maybe you won't listen to those ratings anymore. So, but I think that's a really good one. And I will give a little bit of a plug here with her name being on the screen. Liz Ann Saunders, our chief investment strategist here at Charles Schwab. I love her style of writing. She is very thoughtful, backing up with data, coming up to her conclusions. I love how she writes in that style. I read everything that she publishes. I will give a plug for next Tuesday, June 30th. We have a mid-year update coming on Schwab Live Daily all day long, and Liz Ann Saunders is one of the presenters during the day. So please tune in June 30th, all day, special day for Schwab Live Daily. Lots of Schwab expertise throughout the day. All right, let's take this a step further. Let's go a little bit deeper, and let's look at some of these biases that we come across as investors or traders. The three that we're going to talk about definitely in the presentation is the concept of overconfidence, the concept of illusion of control, and the concept of loss aversion. I know, Mike, today we're going to talk about two additional ones that we're going to add in here. We're going to talk a little bit about the concept of anchoring. I think that plays very well into overconfidence, along with another one that is in the same area, and that is called confirmation bias. So those are the five that we're going to talk about today. So let's start with this concept of overconfidence. Mike, maybe help all of our viewers understand. So when we say that word overconcept or that bias called overconfidence, what do we mean by that?
Yeah, I think, when we think about overconfidence, I think first of all, you sort of have to understand the over part, right? I think it's important to have a certain level of confidence in what you're doing. It allows you to sort of think clearly and maybe make good decisions. But as you get into overconfidence, I think that is sort of omitting some level of risk or alternate view toward what your mind says you're trying to accomplish. And I think a really good example of that is Rob, what you have here, with these different asset classes and kind of our assumptions based on historical performances. And really, we talked about that word averages before when we talked about investor and driver. And I think as we look at these and we sort of connotate the average returns of some of these asset classes, that overconfidence could come in terms of having a perception that we're going to make that average return year over year over year, when in fact, you see some dips that have occurred here, some pretty significant ones as of late. But you think about that average return, and very infrequently do the markets return what the average return should be. Your thoughts here?
Yeah, no, I think you said it very well, because I think that plays into this next slide. Everybody can see that long-term chart that equities do really well compared to bonds or cash or inflation, but it's how do we act when it's actually happening to us? You think about here in March when our markets were down dramatically, and we had reactions. Think about how you felt at the end of March. Did you feel, oh my gosh, yeah, we're eventually going to get back to our average return of, whatever it has been, 6, 7, 8% over the long haul? It looked like a very dramatically unaverage year, right? And then I will build on this because I've read very recently that in this run up, here, so since the lows in March, I believe it has been noted that a large percentage, I heard around 30% of investors have liquidated their equity holdings. Not just sold some, liquidated completely. And, I think that plays into this emotional roller coaster that we experience along the way.
When you look at these words here, Rob, and you think about, I think I saw that statistic. It was a specific age group, fairly close to retirement, but yeah, 31%. But, you think about these different words in and around, what could be constituted as, a cycle as it relates to investment, something that you should be very rational about. And then you put words like pessimism and panic on top of those, in addition to the hope and the relief and all of these other things. And you start realizing that, our emotional reactions to a rational investment decision are probably more emotionally charged than they are rationally charged at times.
Yes, that is it right there to a T. So let's take this. Let's take this and bring in one of those other biases, the concept of anchoring, because I think that plays very well with what's going on in the marketplace. So very quickly, can you tell everybody, Mike, what is this concept called anchoring?
Yeah, it's very easy to sort of summarize, if you think about examples of it. But really, you're looking for a particular outcome, and your outcome is based on experience. And unfortunately, your experiences sort of let you down in that avenue, because your experience may not be a reasonable expectation, but it's already been set. It's been anchored against. Oftentimes what will happen, as an example, is people will buy an asset at a certain price, and then they will gauge their performance of that asset relative to whether or not the stock does well or does poorly. Even though the stock may have done very, very well before they purchased that asset. Of course, as individuals, we don't necessarily care what the performance is before we bought it. We care what happens in our account. And that, my friends, is anchored around the price that we purchased. Very, very frequently, when you're negotiating for, let's say, a car, right? Somebody will go in and they'll give you, maybe a low anchor for your trade-in. And really the idea or the concept there is they're basically throwing you a really low ball number to try to get you anchored around a certain value, so that way when you negotiate, you're gonna negotiate toward a lower number. So this happens, time and time again. But Rob, why don't you connect it to kind of what you were thinking about with the overconfidence?
Yeah, so I think this comes into, with anchoring, I think some of the things that we see immediately pull our minds to it and make our decision around it. I think a lot of people have seen what the market just did, and now we're anchored to, hey, markets can move down very quickly, and we think that's going to happen more often than it statistically actually does. So we're anchored around maybe that low point of, oh, wow, the Dow got down to 18,000, 19,000 or whatever, or I just saw this happen. And I think it can happen on the upside too, with stocks, some stocks that have gone tremendously upwards, made huge rebounds above and beyond. We get sort of anchored into that behavior those stocks have made.
Yeah, I
So,
think
Mike,
when you consider that, yeah, I totally agree, and it's again, it's something that we impose on ourselves, right? It's something that you look at based on experience, but sometimes that experience can fail you based on what is probable or likely.
absolutely. So I like this last slide because I think sometimes there is so much information out there that we need some real perspective when we make decisions. And this slide, I think, really sets the tone for equity investments and how we as individual investors should be thinking about equities. And what it's showing you is the return variance when you invest in equities, and here we're using the S&P 500 index, and if you just bought in and held for 1 year, okay, that's that first bar there. So notice the variance of your returns. Best case scenario, 54%, worst case, minus 43%, all over the board, okay? Notice as you lengthen out your time frames, how the variance of your returns start becoming narrower, much more defined. And even on our 20-year time frame here, hey, the worst case 20-year time frame that we've ever experienced is a positive 3%. Best was 17%, or a little over 17%. So this is saying as your time horizon gets longer, you're probably okay with investing in equities, having equity exposure. Mike, anything you would add above and beyond on that?
Yeah, I love this slide, and I think it's one that probably should get used almost at the start of any kind of planning conversation, as you alluded to at the very, very beginning. Because our perceptions of some of these stocks that we hear about all the time are, these massive, sort of outperformances of broader markets. But when you kind of look at this, this can not only help you sort of understand the risks that are associated with some of those individual investments and really kind of get you, quote unquote, anchored around the right perception, but it also can speak to sort of setting up a portfolio for timeframes that are realistic toward your goals. And having, again, those right expectations, because, being prepared for what happens to you is going to eliminate some of the emotion. Not all. It's the emotional center of the brain that makes decisions, but it's going to allow you to make, more rational or clearer decisions.
Absolutely. That hits on it. Okay, if you want to buy a house and you're going to use this money to buy a house, you don't want to probably be exposing it to the marketplace for a year. You may be buying a 4-bedroom house, or if things don't work out, you may be buying a 1-bedroom house. You're bringing in too wide a scope if you're thinking on the short term. I like how you thought through that. All right, let's move on to our second big bias here. We call it the illusion of control. And it's a little bit of what I alluded to at the beginning of today's session was, you mean all my successes weren't because of my skill and all my failures were because of somebody else? So talk us through a little bit of what this illusion of control means, Mike.
Yeah, it's funny that they bring up this slide, and I think anybody out there listening who's played golf is probably this is gonna resonate with you. And the idea is pretty simple. It's the fact that we love to take credit for successes, and to Rob's point at the beginning, we tend to push blame when things don't necessarily go our way onto some sort of outside stimulus, right? Something was done to us. When honestly, it's a little bit of a healthy dose of both. And I had mentioned that book, Thinking in Bets, and the idea here is not necessarily to think about, playing poker for life or gambling, but it's in essence to think that, a lot of outcomes, they aren't black and white. They aren't yes and no. There's some gray area in there where things can happen, right? I can have a really solid process. I can do all the right things and come out with a poor outcome. I can also do things very, very poorly and, basically throw a dart and have a positive outcome. So, this illusion of control is our brain sort of tricking us into thinking that, really everything in life that happens to us is the ability to do things well on the good side. And we tend to factor out all the bad stuff as things that have happened to us that were outside of our realm of focus.
Yes.
Bob, what do you got here?
That's it. And I think it's really coming down to you were there. It's understanding what you can control versus what you don't have control over, where there is some element of randomness to it. Okay, I'll tell you right now, we have no control over what assets are going to return over the next year, 2 years, whatever. We don't have control over that. You don't have control over what a stock price is going to do over the next year. What we do have control over is how much risk we're willing to take, how much we maybe have exposed to equities versus cash versus fixed income versus other asset classes. We have control over, hey, should I do a Roth conversion this year or should I wait? Should I have control over, should I have my assets with a designated beneficiary? Should I be investigating what a trust is? Because I might run into estate issues and I can avoid the negative finances that come with probate, something along those lines. So it's understanding some of the things that you can control versus stuff that you can't control, but you're going to set yourself up to make as best a decision possible in those areas where you don't have control over.
I would say that we're living through an area right now, not to poke the bear, but given all the things that we've kind of seen in the last 12 to 15 weeks, right? It's easy to say that we could have been more prepared, but being more prepared stop an infectious disease? It may have helped a little bit, but again, it's that illusion of control that makes us sort of think or have, sorry, Rob, but I'll mention another one, hindsight bias, where, we think we could have controlled something in the past. And ultimately, did we really know that something like this was possible or conceivable? And frankly, did we really know that we could handle it as well as I feel like we have? So.
Yeah, I think it's one of those things where everybody understands it's possible, but is it probable?
Right.
And it's
Yeah.
in my history of the market, I mean, I've been in this 30 years. I always like the people that predict the market is going to crash. Oh, they predicted 14 of the last 2 crashes, because they're predicting it to crash every year, right? So let's get to this slide, because I think this plays right very well into this. This slide should be called poor timing on a good decision can actually be a better performer than optimal timing on a bad decision.
It's a good way of framing it. I certainly would agree with that.
And what we're getting to here is, when you think about developing your investment plan or your trade plan, obviously people, you'd love to be able to buy in at the lows, right? Okay. Of course. Honestly, I think that's pure luck. Okay. Obviously, nobody would like to buy in at the highs, right? Okay. That's probably pure luck too. Nobody's ever good as bad as you think you are. You're somewhere in between. Okay. But what we're saying here is, when you think about investing, money that you need for the long haul, even just getting it exposed to the marketplace, we're showing you here, if you would have had bad timing, I mean, if you exposed money every year for 20 years and you bought at the high point over every 20-year period, so if you look at all the 20-year periods for our market going back to 26, if you bought at the high period of those 20-year sections versus the perfect timing, notice the difference in returns. Yeah, there is difference, but not dramatic. But you look at the performance of those versus, oh, I just don't want to invest and just stay in cash. Well, you still have dramatic underperformance relative to even poor timing in an asset class that you should be exposed to that gives you good long-term growth.
Yeah, I particularly love this slide because I hate this slide in a number of different ways. And we've talked about this in the past because, ultimately I think to have perfect timing requires hindsight. You cannot make a decision and know whether or not it was a favorable one, not if it was a good one, but if it was a favorable one until after you see some level of the results. So, I ultimately have a problem with this, but I would argue that the variance between investing immediately and perfect timing is far less than immediate and bad versus no timing or staying in cash at all. And that's the way that I look at this.
Yeah, absolutely. All right, last concept here called loss aversion. What loss aversion simply is the pain that we feel when we take losses far outweighs the joy we feel when we have gains. And this can lead us to make some very interesting decisions. Okay, and the types of decisions that it can lead us to, I like these first 2 here that we talk about is, hey, sometimes we are willing to take our investments off the table way too quickly, or hang on to investments that are not working the way we expected way too long. Okay. Mike, what are ways do you think about this concept of loss aversion?
Yeah, I think you hit the nail on the head at the beginning of this where we talked about, statistically, you feel a loss twice as painfully as the exhilaration of a gain. So ultimately, we're really sort of polarized to the eliminating a pain point. right? But, I think as it relates to this, right, selling winning investments too early versus, holding losing ones too long, I think this goes right back to what you were talking about with that planning conversation, Rob. And the idea is that the market is, of course, asking us to do something which is entirely unfair, right? We're asked to buy assets with no scale whatsoever. Up is an unknown number and down is zero. And very, very frankly, most of the stocks that we invest into, probably won't ever see zero. So, it's up to us to create that scale. And I think creating that scale allows us to sort of quell this idea of loss aversion, where, we can quantify, what downside we're willing to accept. And we're also looking at what upside, we're looking to accomplish. And those can be very, very powerful motivators to keep us away from that emotional reaction.
I think I like how you said that there. We're looking at something without scale because we don't know what the outcome is going to be 10, 20, 30, 40, whatever, how many years down the road. We don't know what that is going to look like. And our brains have difficulty sometimes processing that. Okay, therefore, we
Perfect.
probably make a lot safer investments than what we ultimately need to based on the assets that we have and maybe our need for those assets, our spend pattern.
Yeah, I
Okay.
mean, you brought up
So
another good one, right? That's recency bias, right? It's making decisions based on immediate reaction to events versus what we know to be sound or good for us in the long term.
you got it. Yeah, recency bias. I went to McDonald's and I bought a Big Mac and I won the $1 million on the Monopoly game. Therefore, I'm going to go buy a Big Mac tomorrow too because something good happened from it. I don't know if that's a good example, but
I like it. I'm sticking with it. It's pretty good.
and if you've watched and if you watch the and if anybody's out there watched the whole thing around the McDonald's and the Monopoly game, no, you didn't win it because it was all rigged. So anyway, let's go to the final takeaway here. We talked about a lot of these pitfalls, the traps that we can fall into in making our decisions. What can we do as individual investors to help overcome some of these obstacles? And I want to start with a question. I'm going to send this one to you, Mike. So Eddie in Tennessee, excuse me, Ted in Virginia. He says, as an investor, it is difficult to stay invested over the long haul. So as a self-directed investor, he's finding it difficult to stay invested over the long haul. What tools do we have to help him stay the course over the long haul? How would you guide him there, Mike?
Yeah. I think that this is, one of those questions that I might pay an audience member to ask me, to be fair, Roger, because, I'm sure that just, tons of people are feeling this way, especially given kind of what we've been through. And, I would say that some of our earlier comments, particularly your comments about the planning process, really could help. And there's just an abundance of planning tools, portfolio tools on our website. And, the urging there is to be able to stay invested. There has to be the ability to withstand outcomes, and those outcomes can be be withstood by understanding life events, understanding what the needs are for the assets that are being invested. More importantly, when they're being needed. And then as I had alluded to in that slide that talked about, the outcomes from a year versus 20 years, really sort of setting up that risk picture to make sure that, as you get closer to needing that money, that you are able to withstand the outcomes in the short term. And if not, adjust the allocation. So, we probably could spend a whole hour on this question, Rob. I mean, what are your thoughts?
Yeah. So my mind when I saw that question come through was immediately to it's building a plan around it. And I think there's some important things. It's Ted, understanding where you are financially now. Okay. Not only, it's your assets, it's your income, your spend pattern, and then having some semblance of, okay, well, where would you like it to be down the road? And that could be 5 years, 10 years, 20 years, whatever you want to put on there, and then developing what are the potential paths to get there. I think when we understand that we're going down a defined path with actionable things to do on that path or actionable ways along there, I think we become much more comfortable. We see how the numbers work out. We feel comfort in that plan. We become less emotional around it. That allows us to stay the course. So what could you do? I know you mentioned some of the, we have tools on our website for that. I would actually reach out to us, call us at Schwab, okay? And because whether it be potentially in one of our local branches, contacting one of our branches, calling our 800 number, we have lots of individuals to help you start building and complete some semblance of a financial plan for yourself. That to me is the big first step. That can tamper down a lot of the emotion to keep yourself on track.
Robert, as we think about answering that particular question and we look at this slide, I would argue that we should almost reverse the order here. I think if you go from 3 to 1, you think about making a plan, right? And trying to put it to action. Notice I used the word try to put it to action,
yeah.
Right?
How would I do that?
You got to know yourself as an investor in order to do that. And I think only once you know yourself as an investor, really, just at how you make decisions at certain stages in your life, that's when you can learn to respond rather than to react. And those are the 3 bullet points that we had there in that last slide.
Yeah, and I actually think this slide does that. It reverses that order. I agree with you on that. And what we're showing you right now is the 7 fundamentals that we feel can lead to investing success. Okay, these are the ones that we have come up with here at Schwab. And notice the first one is essentially establishing a plan based on your goals. Okay, what do you need to have happen? We have lots of individuals at Schwab that can help you with that process. All you have to do is call us, get a hold of us, get a hold of a branch, somebody at Schwab. We are there to help you do that. Okay? And there's lots of action steps along the way. I know in the previous slide we talked about learn how to respond versus react. To me, I think of that as our 6th tenet here. Rebalance your portfolio regularly. Okay? It's okay, here, I need to rebalance, get back to what I feel is appropriate equity exposure relative to cash, relative to fixed income, relative to metals, relative to real estate, you name it. Rebalancing is not emotional. It's very thought out on how we're going to do it.
I would also argue that it keeps you from being emotional, right? Because you start getting concentrated in any one area of that portfolio, you're going to bring in added volatility in the account value changing, which could lead to, those emotional reactions. So again, sort of, dovetailing back into that question that we had, that rebalancing part can really sort of help you, quote unquote, stay the course.
I want to just give a quick shout back out to Ted. Hey, Ted, thanks for the response question there. Yes, please reach out to one of us. We are happy to help. And Ted said he just came over from USAA. So I'd like to give a nice thank you to all the individuals that came over from USAA. We are happy to have you here, part of the Schwab family now. What a tremendous partnership of 2 firms that think so alike in trying to help our clients have success and do it the correct ethical way around it. So welcome to all the USAA people out there. Please reach out to us for help. We have lots of great tools and resources to help you all be successful. So Mike, I'm going to leave it on this slide, and I'd like maybe you to think about, are there any of the other numbers on here that really jump out to in your mind um, about some of the important steps to success that we should highlight for the people watching today?
I know we talked about a financial plan, Rob, but based on on your goals, I think is another thing that maybe we touched on a little bit at the beginning in your talk about performance, and maybe something that we should highlight here is just the sense that performance and what you need out of your portfolio, can be very, very different. And I think understanding what those goals are and working backwards from those can eliminate a lot of risk, a lot of angst and emotion, and also just make sure that you're thinking about things the way you need to, because investing is one of the most individualistic things that you can do. And in my mind, that goals word is really, one of the biggest things here. I'm more of a big muscle guy and not a small muscle guy. I want to make sure I'm doing the right things fundamentally, and then the little things will probably wind up, falling into place.
I like that. I think that is where we're going to leave it for today. So this is behavioral finance. Coming up tomorrow morning, please tune in 10 a.m. Eastern, 7 Pacific for Hawaiian Trader Talk in Today's Market with Lee Bull and Kevin Horner. And I'll make one more plug for next Tuesday's special day on Schwab Live Daily, the mid-year update. I know we have some wonderful speakers. I know Liz Ann Saunders is going to be on. I know Kathy Jones is going to be on talking about fixed income. I think it'll be really interesting to hear from her, specifically with all the variance that we've seen in the fixed income market and rates all now close to zero, how to be thinking through that. So lots of great things coming up next Tuesday. I hope everybody has a wonderful evening. We'll see you tomorrow morning at 10 a.m.